Today we're going to talk about the wheel strategy. This is a strategy that I plan to implement once the Bitcoin mining trade is over. And believe me, someday it will be over, at least for a couple of years, at which point I'll need to be doing other things to make money. So in this situation, I will be turning to the wheel strategy. I've already been practicing this with Palantir. I plan to start doing it possibly with ARM or once the stock split is done with NVIDIA, and that will be quite exciting there because there's a lot more premium to be made on a stock like NVIDIA versus something like Palantir. But we're going to take a look at that right now. Well, first we're going to talk about the wheel strategy. So first of all, this is the wheel strategy right here, this little graphic. You start by selling a put option, and what that means is you collect the premium of the put option versus paying the premium for the put option. And the only difference is that if this option is assigned, then you must buy 100 shares of the underlying stock. And that's really just the biggest difference versus having to buy the underlying shares. I mean, of course, you could do a non-execute on a bought option, and that's fine. But on an option that you sell, it's up to whoever bought it to execute or not execute that option. Okay, so that's you collect the premium and you give someone else the option to execute it on you if the conditions are met. And then the second step is, are you assigned? No, you go back to selling the put option. Put option again. Are you assigned? Yes, you go to selling a covered call. I would be selling a near the money covered call, something maybe a few strikes out or like right above it if I think we're on a line of resistance. And then, of course, you collect the premium from that. And then we go back to the next step, which is it assigned? No. All right, then we sell another covered call. Or if it's assigned yes, we go back to selling puts again. And it goes around and around and around like a wheel. Okay. And so it looks a little bit like when we do this here. So this is ARM. This is the ARM's option chain. All right, this I've had it set here for June 21st, about 1 month out, a little less than a month at this point now out. Okay. On the right here, you can see open interest. Right there on calls, open interest is this first column, on puts is this last column. The price on puts is this first column versus calls is all the way on the left there. Okay, so we're going to look at open interest to see where is our call and our put wall. In this case, you can see it's glaring. It's right here at $90. There is a put wall at $90, meaning the price of this would struggle heavily to get below $90. You can see there's, several times the amount of interest at $90 than there is at any other strike price on this put here. You can see there's 17,000 open interest, almost 18,000 contracts of open interest at $90 versus, say, something at $100, which is 3,000 open shares. Now, do I really think it's going to get below 100? Likely not. This does seem pretty hopeful that it's going to get all the way back down to $90, but it's totally possible. It does need to fight through 110, 105, 197, which represents what, like 8,000 contracts just to get to the point where it hits 95, where it comes into about 10,000 contracts worth of volume before it gets to 90. So it's got a lot of volume and open interest before it even gets down to $90. So I don't think it would go that low, but that is where the put wall is. Like that's where the line in the sand is. If it gets below that, it's going to crash kind of situation. Now let's take a look at the call side of things. So on the call side of things, it's a lot more even. You can see it's kind of just stepping up from 115 all the way up to 155 realistically. It's just constant volume all the way up there. So we know that there's a lot more resistance going up than going down right now. In fact, it looks like the price kind of wants to be pinned between this $100 level and this 125, 130 level for a while here. That's actually good for us because if it goes sideways while we're selling options, we actually tend to make money in that situation versus going up or down. I mean, obviously, if it goes up or down, you'll make your money faster, but if it goes sideways, you make it all the same. Now, let's go to the ARM maximum pain. I like the maximum pain web page. You can come in here, you can put in the ticker here, you can put the maturity date there. I put ARM at June 22nd, and we can see here that max pain is actually $111. That means that at this point in time, where all the calls and puts are sitting, if the market were to close at $111 on June 21st, that the most amount of these options calls and options would end the day worthless, meaning that the market makers make the most amount of money if price is about $111 on close of that day. That's all. The other bit of really important information here is one total open interest amount. which is 84,000 right there, versus, and then also the put and call ratio, which means, this is, puts over calls. So are there more puts or more calls? In this case, the higher it is, the more puts there are, the lower it is, the more calls there are. So it is over 1, so there is basically 16.55% more puts than calls open on ARM for this day right now, meaning that the pressure is pushing it more downwards than upwards at this time. Okay, so anyways, with that said, let's go into doing some of the math here. So if let's say we did a $100 put option on this, that would be net you 90 cents per share, which comes out to 100 shares, about $90. So this is for 1 month. You get $90 for that month, and you'd need to put up about $10,000 of capital, potentially, in order to collect that $90, which would net you about 0.9% per month. That's not amazing. So let's adjust this a little bit. Let's go all the way out to August 16th. That's about 3 months out. And let's go look here again. $100 now is $470. Okay, so if we're convinced that, now if we thought price was going to go up, right now I'm not so certain, but if we thought price was going to go up, we feel pretty confident about it. This is where technical analysis comes into play. We feel pretty confident that price is going to go up from here and not down. We could go out a little further, and in this case we'd get $470 for that $100 put that we sold. And in that situation, if we collected the entire premium, of course, we'd be getting about 4.7%, or 4.7%, or this is 3 months, so it'd be 4 times a year, about 18%. Okay, so $470. Now, let's say we wanted to try to collect this in about 30 days. We did the technical analysis. We think in about a month it's going to go up, and we can collect maybe 60% of the value of this premium in 30 days. That would be $282. Divide that by 10,000. What is it going to be? 2.82%. Yeah, 2.82%. And if we could do that successfully month over month, we'd be looking at about 33%, which in the case of $10,000, that'd be $3,384 per year. Okay, and if you've got $20,000 or $30,000, let's just say you've got $20,000, you could do that twice, which would get you $6,000 a year, or over $500 a month, if you were able to successfully pull off this every single month. Now, I'm assuming there's going to be some margin for error there. You might collect maybe 60% of this, maybe 70% of this, and not capture that whole amount that you're aiming for. So we would sandbag this model a little bit in order to get it a bit more realistic as to what you would actually collect. But with just $20,000, you can make $500 a month potentially. Now let's sandbag it a little bit. Say on like best case scenario, you're going to collect 60% of that amount, right? So you're collecting 60% of the 60% at this point now. And with $20,000, you're still producing about $4,000 every single year. Now, of course, not all of us only have $20,000. We could be working with $50,000, $100,000, $200,000. Let's say you had $100,000. That'd be 10 contracts. Okay, you could do 10 contracts at 470. You collected 60% of the revenue, 282 times by 10. We're looking at $2,800 a month, or about $33,000 a year off of a $100,000 portfolio. Now, of course, you're not going to put all your eggs into one basket here on something like ARM. You would spread it out. Do it on different stocks, different industries, and you collect different amounts. But this is just the power of it on one stock. This next one is one I've actually been doing. I've actually been doing Palantir. So I would come into the chart here, and I like the weekly for this one. Palantir chart actually looks a bit weak on the weekly, to be honest. It is coming up on this kind of area of support here at around $20. We can see that it's based like this before in the past. Last time around $15 before it launched, but I believe that was earnings that sent it flying. Let's take a look. Yeah, it was earnings that sent it flying. Earnings is already behind us. Earnings did send it flying, but it immediately gave it back, mostly because insider selling. There's a lot of 144 filings with the SEC with Palantir that they filed just 5 days ago. So there's been a lot of insider selling coming through on this stock right now, which I expect to dry up quite soon. And once it does, I expect it to start taking off again from there. So let's just go ahead and look here on the weekly. So I would be looking for price would need to get up and above and hold above $22. Honestly, I would need to see it above $22. It needs to get above these two candles here and hold there for about a week before I'd say, yeah, it could go back up into the $23 or $25 range again. The longer it's hanging out towards the bottom of these wicks here at about $20.50, the more I'm thinking it could come down to 19. I would be happy to buy this at 19, but if I think it's going to come down further, I'm not likely to sell a put because I could get more premium the further down it comes. Okay? This is where the patience kicks in. And if we're still in this descending channel, which we absolutely are, it could go as low as, well, 1 to get to the middle point would be 19, but it could go as low as 17 to get to the bottom of this channel, and that would be just next week. If it hit the bottom of this channel just in 1 week, which it could totally do, because if we look at this candle here, it moved how much in 1 week? It's moved 19% in a week just 3 weeks ago. So if we go from where we currently are and we went down 19%, guess where we come to? We come right to that $17 range. So it could absolutely do that in 1 week. So I would be looking around the close of next week to see where price is. Is it still flat, hanging out here, making something of a bear flag off these last 2 weeks right here? Are we still doing something of a bear flag, which would indicate we're going to come closer to that 19 level? And once it gets to that 19 level, I'll watch it. Is it going to come to 17? Is it going to come to 18? Is it going to get to the bottom of this channel? Is it going to come to the center and reverse? I don't know. So I'd be watching and waiting and being patient on this, which is one of the factors into why I don't think you'll capture the whole 100% of the premium all the time, because you got to be patient. You have to wait. You're not always going to have, the right time to strike. So there might be months where you don't collect any premium. There might be weeks or months where you don't collect any premium, or there could be just back to back if the market is, cooperating with you. So there's going to be some give in the model. But let's take a look at Palantir. So I've been doing this for a while. I've actually, to date, since I've been selling options on Palantir, I've collected about $600 in options premium off of these contracts, working with about $5,000 to $6,000 on it. Okay, so that's been working out quite nicely. Now, if we look at just a month out on Palantir, honestly, it's terrible. You get $18 for doing a $19 put. Okay, that sucks. But there's a ton of volume. If you look at $20 is the put wall. It's likely not going to go below $20. So you probably could do a $20 put on this thing over the next month and likely collect your premium. That's very possible. But if we look at the call side of things, you can see there's 49,000 at $25. So it's likely not going to go much higher than $25. And in fact, $22 is a pretty big hurdle on its own, which is followed by $23, which is a decent hurdle. And then 24 is less of a hurdle up to 25. So there's a lot of options. There's a lot of volume on this thing. So it's just pretty great. So I would be feeling pretty safe right now at a $19 put option on this thing. Of course, this is not financial advice, not a suggestion to buy, sell, or hold any asset whatsoever. Just my thoughts when I look at these options chains and stuff. So let's look at the maximum pain for Palantir. So this is Palantir, June 21st. Maximum pain is in fact $21. So market makers are interested in getting this thing up to $21 or holding around $21 in order to make the most amount of options contracts expire worthless, meaning the market makers make the most amount of money in that situation. You can also see here that the put to call ratio is actually all the way down at 0.56, meaning there are significantly more calls than puts right now, twice as many calls as puts right now. As you can see right here, call open interest is 322,000, put open interest is 182,000, meaning whoever is buying the contracts is super bullish, and whoever's selling them, which is often institutions and market makers, are feeling like price is not going to go much higher than $25, meaning that's you've got a cap on the upside here. So the lean is up, but there's a cap on it at about $25, meaning once it hits $25, it's likely to be hit with a flood of selling and come right back down, probably to around $21. So that's the set up here. So with that knowledge, I'd come over here and I'd go out to about August, about 90 days, right? What is my 19 at? At 90 days, so just a 90-day put, if I sold it at $19, it'd be $100. If I sold it at $20, it would be $139. Now, the thing I like about that particular number, $139, right? So if we did 20 minus 1.39, right? So the person paid you is going to pay you $139 for the option contract that you write for the put option. Meaning that this put option doesn't become profitable unless price goes below $18.61. So that means that if the price does not go below $18.61, they would lose money if they exercised that contract. So there's no point doing it. So you're safe here. Actually, you are safe on a $20 put all the way up to $18.61. So you could be in the money at $19. You could be in the money at $18.66 on that contract, and it would still be unprofitable for the person to execute it on you. So it is unlikely, unless they don't know what they're doing, it is unlikely that they will execute that contract on you and make you buy those shares, because at that point they would still be losing money. So I would feel pretty safe with a $20 put option on Palantir 90 days out at this point. I would be, because you can see here there's a decent wall here on these. Like 2019's got another 12,000 contracts, 18's got another 12,000 contracts, meaning if it gets to this level and even just peaks below it, there's likely to be buying to come through, because those options could get exercised, and then the buying would flood in, causing price to go surge back up fairly quickly. Now, and you got a 90-day buffer. So let's say $139 divided by $2,000. That's a 6%. 6% move on that. Now, if we collected, let's just say we collected 60% of that in 30 days. That's $83. Okay, $83. Not too bad. It's a lot better than $18. Okay, it's a lot better than $18. And so we collect that 83 premium. That's what we're hoping to collect in about 30 to 40 days, right? And we did that, divided that by 2,000, looking at about 4% per month if it plays, if things work out the way we want them to, which would be about 50% a year. So you'd be looking at collecting about $1,000 a year off of 2,000. And let's see, we scale that up to, let's say, $24,000, right? You could collect about $1,000 a month off Palantir, about $1,000 a month off of Palantir, if you were able to successfully execute this plan on the wheel. Now, with my Bitcoin miners, I'm planning to make significantly more than that just this year, so that's going to be exactly how I'm going to make money during the winter, when things start cooling off. So hopefully that made sense. If it didn't, give me some comments, some notes, how I can better display this information, because I really want people to understand it and be able to use this sort of use these charts, use this information in order to try to make that more actively passive income. Like it's kind of passive, but there is some work that comes into it in order to make it happen. So please like, comment, and subscribe, and have a profitable day.